Tokenized stocks, your profits untaxed. While grown adults with finance degrees keep crowding into the same handful of hype stocks, a teenager has quietly built a portfolio that is beating a lot of them. He is 15, his name is Karen, and more than 200,000 people follow his every move because he hides nothing. Every position, every buy, every sell sits on a public page, and I have linked it in the description so you can pull it up yourself. And that page reads like a scoreboard. The whole portfolio is up about 76% all time. His 5 biggest positions are all green, up between 45 and 190% each. His single biggest bet, nearly a third of his money, is up 86% and has already made him 6 figures by his own account. So what has he actually been buying? Follow his feed for a month and you can watch the machine work. In late May, he tore apart the new filing of a famous 25-year-old fund manager and pulled out one overlooked solar name. It is up about 40% since. In early June, he made the case for the laser maker wiring AI data centers together, AAOI, and that single position had already paid him nearly $50,000. It now sits up almost 60% in his book. A week later, he published a memory thesis that reads like a hedge fund note. The fastest growing corner of semiconductors, still priced at a fraction of the AI names it feeds. And since Korea's memory giants do not trade on a US exchange, he bought the fund that holds them instead, EWI, one ticker that hands you Samsung and SK Hynix in a single position. It is up over 50% on exactly that idea. And when the headlines screamed about the president's 3,000 trades, he skipped the argument entirely and moved to mapping the next themes, drones and quantum sensing, before the crowd got there. How does a 15-year-old end up here? 3 rules, and each one is the opposite of what you normally hear. First, he refuses to buy the loud names. And be clear about what that means. He owns plenty of chips, memory, lasers, silicon everywhere. He just owns the ignored kind, the layers trading at 5 to 8 times earnings, instead of the one superstar everyone pays 20 or 30 times for. He buys the unglamorous companies underneath the star, the ones supplying the parts, the power, and the plumbing the whole boom is built on. Second, he does his buying when the screen is red. His largest positions were built during this year's sell-offs, while most people were panicking out. Third, he does not chase headlines, he mines them. When a story breaks, he skips the obvious stock and hunts for the quiet supplier one layer behind it. So let us look at what those rules actually bought. Start with his biggest bet, nearly a third of the portfolio, up 86%. Penguin Solutions, ticker PENG. Think of it as the general contractor of the AI world. When a company wants its own AI factory but has no idea how to build one, Penguin designs the cluster, builds it, runs it, and sells the specialized memory it chokes without. And that memory part is the quiet kicker. As AI shifts from training giant models to actually running them all day, every day, the bottleneck moves to memory. Penguin's memory business is already half its sales and growing more than 60% a year, with names like Meta, SK Telecom, and Shell already paying customers. It is the rare company that gets paid twice, once to build the factory, and again to feed it. That is Rule 1 in action, and it is why this single stock holds more of his money than anything else. His second biggest bet is up 190%, and it is the purest landlord in all of AI. NBIS, ticker NBIS. It builds data centers full of GPUs and rents the horsepower out by the hour. And the demand there is not a forecast, it is signed in ink. Microsoft committed up to around $19 billion over 5 years. Meta followed with a deal worth up to $27 billion. Nvidia put $2 billion of its own money in and guaranteed it first access to its newest chips. Stack it up and that is roughly $46 billion of contracted revenue running years deep, at a company whose revenue just grew almost 700% in a single year. Whoever ends up winning AI, they pay rent here. Then come his 2 newest calls, and this is where it gets interesting. OUST, ticker OUST, makes lidar the laser eyes of physical AI. Robots, self-driving cars, drones, every machine that moves through the real world is blind without this sensor. Now connect 3 facts. 1. The 2 companies that dominate global lidar are both Chinese, shipping over 2 million sensors a year between them. Two both just landed on the Pentagon's list of Chinese military companies. And on June 30th, two American bans went live at once, cutting Chinese firms and Chinese lidar out of everything defense touches. 3. OUST's biggest Western rival went bankrupt last year. Added up, and all of that banned demand, defense, government infrastructure, and the contractors serving them, suddenly has one scaled American door to walk through. And that door is still small. Under $200 million a year in revenue, growing about 50%, with gross margins in the mid-40s, $175 million in cash, no debt, and a factory already scaling toward 100,000 units a year to catch what is coming. It is inside counter-drone systems and state highway networks today, and the day the bans took effect, it announced its sensors qualify for Buy America infrastructure money. So yes, after a 50% run in 1 week, it trades above most analyst targets. But the bet here is not last quarter's revenue. The bet is that when a market this size is forced to change suppliers, the last American name standing grows into numbers nobody's price target is modeling yet. And Forgent, ticker FPS, does the least glamorous job in the entire stack, and maybe the most valuable one right now. It builds the switchgear and transformers that physically get power into data centers. That is the tightest bottleneck in the whole build-out. Everyone has GPUs, and nobody can plug them in fast enough. Forgent's whole pitch is speed to power. It makes the entire electrical backbone under one roof, mostly in American factories, with some of the shortest lead times in the industry. And the numbers say the pitch is working. Guidance just got raised to about $1.4 billion in revenue, up more than 80% in a year. The backlog sits near $2 billion, more than double a year ago, and new orders are coming in at twice the rate it can ship. It competes with giants like Eaton and Vertiv, but it is the small, fast, pure play among them, which is why the stock is up about 85% since its February IPO. Around 11 times sales, it is not cheap either. It is what contracted, structural growth costs. Now step back and look at what he actually assembled. The builder, the landlord, the eyes, and the power. 4 companies, 4 different layers, 1 thesis. Whichever chatbot, model, or robot wins the decade, all 4 get paid along the way. That is what buying the shovels actually looks like, and a 15-year-old put it together more cleanly than most professionals. The homework is done, it is public, and it is free. The only question left is execution. And execution is where most people quietly fall off. They see the idea, they even agree with it, and then they never act on it. The playbook itself is the lesson. Own the machine, not the hype. A kid figured that out. The only thing left is how you own your piece of it. And, for most people, here's the honest answer. Through a broker, you trade market hours only. On-chain stocks trade 24/7, 365, straight from your wallet. We prefer on-chain for one reason above all. Your profits stay yours, untaxed, already trading on Ondo and X stocks. Not financial advice. Do your own work on the price you pay.